Hey, market disruptors. I'm sure you've heard of venture capitalists. Those are the guys that invest into early round companies, usually tech companies, and they make a ton of money. But what is it that they do that's so different than everybody else? And what can we take from them to put into our own investing so we can make a lot of money just like a venture capitalist? I'm gonna break it down exactly how you can do that, so stay tuned. Welcome back. So, as I said, venture capitalists, right? They get in on the best deals. They invest really early and they make huge returns. But they have a very, very specific strategy that they use in order to make a lot of money and at the same time protect themselves, because investing into very early stage companies is very risky, as you can imagine. Now, there's a lot of parallels to what they do and what we do investing into crypto and blockchain companies. Now, a lot of people that are, maybe traditional investors, or if you don't know much about investing, they're looking to these crypto assets and they're trying to value them, right? And well, I know stocks, they have income and there's profits, and so I take like a price to earnings ratio, and there's all these metrics of how you could value a public company, a security, a piece of real estate, and there's all these different metrics for different types of assets. But a lot of people are having problems figuring out how to value a crypto company, a crypto asset, a blockchain company. And that's because they're so brand new. It's such a new piece of technology that there's really no good metrics. And most of them are early rounds, early stage. And so there's no profits, there's no P to E ratios or nothing like that. And so what I believe is that investing into this market, into the crypto asset space, into the blockchain space, is exactly like what a venture capitalist does. We're looking at companies that are just an idea at this point. We're looking at companies that are looking to bring a new technology into market to solve a new need, and we're having to somehow assign value, a future value to that. We're gonna look at the 8 ways that a venture capitalist does this to make a lot of money, protect the risk and the downside, and how we can use these for our own advantage. So let's get right into it. The first thing that venture capitalists do is they look for really big trends. Now, if you've been following my videos, I talk about the trend and the trends within the trends, okay? So that's what venture capitalists do. They're looking for big trends and they're looking for trends within the trends. So, first of all, they're looking for global trends. They wanna make sure that these are big trends, not just local trends, but they're big trends. Like the video we talked about the pendulum swinging, and the pendulum is right now maxed out on the centralization pendulum swing, and it's moving to decentralization. So that's a big global shift that we want to focus on. The next is they look for the trends within the trends. So within that, what are going to be, so that's the big trend, is the world's going to move back to decentralization. So what are the small trends within that? They look for smaller trends like, for example, like the sharing economy. So just, in the last few years, this new economy, this new trend called the sharing economy popped up. And that's basically like Airbnb, right? Or Uber. So they basically said that, all right, we have all these houses or these rooms that are going unused, so how could we tap into that? And then, so of course, that created this whole trend of sharing economy investments. If you live in a big city, you might have seen these scooters littered all over the city, and that's another trend. So we see these trends. So those are trends within trends, and so venture capitalists would look for plays that fit within that narrative. Shared computing is another one. So we have extra space on our hard drives, extra bandwidth space on our internet connection, extra processing power. And through decentralized technology like crypto assets have, like storage coin, file coin, video coin, things like that, they're using this decentralized technology to tap into those assets like a sharing economy, but using technology. So we're looking for those trends and we're looking for opportunities there. Other trends, global trends that we're seeing are like a loss of privacy, a lack of privacy. So then we go, okay, that's a big trend. What opportunities are there for us? And so if we see a good solution, we know that's good. We see like increased censorship. China's a big proponent of that right now, massive censorship, and we're seeing that all over. Even in the United States, we're seeing a lot of censorship, loss of value. So where we've been able to store our value in the past isn't working anymore. So those are all big trends. And if we can see companies propose solutions to that, we know there's going to be good places for us to look to put our money. All right. Now, number 2, They look for really big ideas. So we want to make sure we're in the trend, but we want to look for a really big idea. Not only does it have to be a big idea, but it has to be in a big market. So really what I like to say is we want it's going to solve a problem that has unlimited demand. So for example, Bitcoin is setting out to bank the unbanked. There's over 2 billion adults in the world with no access to banking. Not only can it take care of the people that have access to banking, but there's 2 billion more people. So that's a problem that has unlimited demand, if that makes sense. We want to make sure that the company, they have a big idea, but they have single-minded focus. If you look at a lot of companies out there, you'll see that they're trying to be everything to everybody, but that's not possible. You can't be everything to everybody. You need to have a single vision, a single mission, and it needs to be very clearly defined. If a company can't clearly articulate to you what the single purpose is, what their mission is, then they're not clear. I also want to make sure that there's new solutions to problems, and they're not just improvement offers. So they're not taking something that we can already do and maybe trying to make it like a little bit better. We don't care about that. We want something that's never been done before. That's why companies like Uber have returned so much money, because before Uber, you didn't even have that option to tap into these unused cars and seats in cars and whatnot. So it was a massive shift and had unlimited demand, right? Cars all over the globe. And it wasn't just an improvement offer, it was something new. The third way that a venture capitalist would look at things is they want to understand the fundamental parts of the business. What is the company doing? What are the core pieces, right? So they have to get in and they have to ask questions. Now, of course, a venture capitalist, if they're going to invest into any one of these new startups, they're going to spend a lot of time with the founders. With a lot of crypto assets, with a lot of cryptocurrencies, they have, communities, Telegram groups, Discord groups, they're on Twitter, whatever, and you can get in there and you can start at least asking questions to their community managers. You got to dig in, do your research, Google search, find out why they're in business. What exactly are they doing? What's their competitive advantage, right? We want to find out what the market is, and who their team is, and where's that product market fit, the market team fit. Do they have technology experience? Do they have experience taking a new technology and launching it? Make sure that there's a history of success with that team. And then we want to make sure that they have a clearly defined go-to-market strategy. So it's not enough just to have a great idea. It's not enough to have a great idea and to actually be able to build it. You have to be able to get it into the market. You have to be able to get people to start using it. So understand these key pieces, these fundamental parts. Ask the questions. You're going to need that, all right? Number 4. What we have to do is we have to forecast our future value. So it's not about what is it worth today, it's really what is it going to be worth in the future. And the way that we can do that is we can look at other markets. So for example, Uber, again, being a good example, right? We would say, okay, well, they're looking to create this ride-share app, this decentralized, this ride-sharing app, but there's no companies like that, right? So how would we value it? Well, we could look at the total size of the ride market, the taxi market, the limousine market, and go, okay, if they could take a piece of that, right? Like with Bitcoin, how much will Bitcoin be worth? Well, there's a couple ways we can look at Bitcoin. One, we could say, well, it's going to be a superior payment method. So if we look at all the payment companies, the Visas, the MasterCards, the American Expresses, the Western Unions, and we add all that up, we're at, almost $1 trillion if we add that up. And if we say, okay, well, if Bitcoin can take half of that market share, that's $500 billion. Or we could say, well, I think it's going to be a global currency. Well, the global currency market is about $70 trillion. So could it take 10% of the global currency market? That'd be $7 trillion. So you have to figure out, okay, what market is it going into? How big is that market? And what percentage of market share could it get back, right? And that's also part of the second point, is understanding those markets that's gonna disrupt, right? So we're looking at the markets and we're gonna figure out how much of that market share it can grab. And then we want to focus on the potential share, right? So the percentage of that market. Can it take 10%? Conservatively, 50% at some point. And of course, we always want to be conservative with our numbers. Number 5, understanding the path to profits, all right? So if you guys have ever watched the show Shark Tank, one of the first questions that they ask, especially Mr. Wonderful, he's a little ruthless.
You're an get the out of here. Oh!
And he says, how am I going to get my money back? All right, so anytime you're going to invest into a company, you need to know how you're going to get your money back. They need to have a very clear path to profits, a very clear path for you to be able to get your money back, right? So always ask that question. If you're investing into a company, are you getting a token back? Are you getting a security back? Like, what are you getting back? And then how is that token or that security going to grow in value for you to get your money back plus the profit that you're looking to get? They need to have a very clear path to that. Again, if they can't articulate this to you, they probably don't know themselves, right? In addition, we want to have like a detailed plan for spending. So again, back to Shark Tank.
Get the out of here.
They'd say, well, how are you going to use the proceeds? So these companies, they're raising money. You're a venture capitalist, right? And they're trying to raise money to build this technology, take it to market, pay the developers, shareholders, etc. So look, how are they spending this money? Now, in the ICO boom of 2017, we saw a lot of these companies just go crazy on marketing. They were sponsoring every event, paying all these people, and now they're broke and they didn't build their product. So look for companies that are blowing a lot of money on marketing. That's like a for sure sign that they're kind of going down the wrong path. But again, ask the questions, talk to the founders if you can, talk to the community managers, look on the website, see how they're using their money. Are they investing it back into the company that's going to allow it to grow? And then ultimately, like I said, how is that token or that security going to accrue value? What you don't want is you don't want what we call the greater fool theory. All right. So what is the greater fool theory? A greater fool theory is that I'm going to buy something in the sheer hope that a greater fool will come behind me and pay more for me. That's what speculators do. That's what gamblers do. We want to make sure that they have a clear path to profits so we can get our money back. If you're liking this content, make sure to give me some thumbs up and give me some likes. Of course, leave your comments down below. You know that I answer every question. I love to engage in conversations with you guys. It helps me to learn, helps you guys to learn. Oh, and we're answering questions on a separate video every week. So if your question gets picked, you get $10 in Bitcoin and you could win $50 in Bitcoin. So leave your comments down below and give me some thumbs up. Number 6. Follow the smart investors. Follow the smart money. I like to say that success leaves clues. So we follow other successful people. We do the same things that they're doing. Hopefully we have some similar circumstances or similar results. Now, in the investing world, retail investors like you and I, unfortunately, we're called dumb money. The smart money are the institutions, right? The institutions that have trillions of dollars, hundreds of billions of dollars at play. And so they have to usually publicly disclose what they're doing, and so we can kind of see what they're doing. Venture capital rounds, we can see the venture capital firms that have gotten on board. If these big venture capital firms have gotten involved, then that kind of shows that the market is supporting it. These are the smart money. And so most of the time, these projects are going to kind of disclose who their venture capital partners are, who their big investors are. If you have some funds that you're following, then you can go onto their websites typically and see what projects they're investing into. Again, some of this takes some work, but if you dig around, you can find out where the smart money is going, and then you can follow them. So don't listen to the hype. Forget the most hype coins on YouTube and Twitter and Facebook and Instagram or whatever you're getting your data from. Don't listen to the retail investors, again, right? The dumb money. Follow the smart money. Number 7, this one's a very, very important one. You have to manage your risk. All right, this one's super important. I say that the best way to make money is to not lose money. Losing money is asymmetric. So if I lose 50% of my money, now I have to make 100% just to get back to even. So you don't want to lose money. So you always want to manage your risk. That being said, you have to be okay to fail. Venture capitalists will fail more than they succeed. The majority of their investments will lose money. So you have to be okay to fail, but you have to manage the risk, all right? So you know there's gonna be risk. When you're investing into early stage companies, there's risk, right? It's too early for them, right? You could wait until that company like Amazon's out today, and of course they're the leader in e-commerce and they're probably only going to continue to grow, and so the risk is much less. But investing into Amazon in 1997 when they came out had massive risk because you couldn't even buy anything online at that time. So it was just a big idea. How do you manage the risk? Well, a couple ways. First of all, through diversification. You want to diversify your portfolio by spreading around. Venture capitalists will typically raise a fund, and then they're going to put their money into about 10 to 15 plays. At the end of the day, they're going to risk about 5 to 10% of their total portfolio into any one play. Think like a venture capitalist, diversify, spread your risk out. Then what they do is they invest in stages. So what that means is if I've decided, let's say that I have, for round numbers, I have $10,000 and I want to put that into 20 positions. All right, so it's gonna be $500 per position. But then what I would do is I wouldn't put all $500 in at once. What I'd say is, okay, I'm gonna put $500 into this new company, but I'm only gonna put 200 of it in today. Now, I know what their roadmap is, I know what their path to success is, I know the milestones they have to hit, and as they continue to hit those milestones, I'm gonna put more money in. So once this new crypto company launches their mainnet, well, okay, great, that was a good milestone. I'll put $200 more in. Once they've got their first major partnership, they're listed on their big exchange, I'll put 200 more in. And so you kind of have these stages, and now you may be asking yourself already, well, now you're going to be paying more for it, right? So let's say you could have bought it at $1 and now you're buying it for $5 and $10. Well, you're right that you're not going to make as much money, but again, what we're doing is we're managing our risk. All right, so we've decided to put 500 in a position, but we're going to put it in stages. And so each one of those stages, we feel more and more confident, so it lowers our risk down every time. Again, a venture capitalist isn't always trying to swing for the fences. It's not about greed. It's about protecting the downside, right? It's about hoping for the best, but planning for the worst. So diversify, spread it out, 10 to 20 positions, and then invest in stages. And then the last thing is that a venture capitalist understands what their risk profile is, and then they look for companies that match that risk profile. So obviously some are way more risky than others, and some are safer than others. And you have to understand what your risk profile is. There's no answer for that. I can't tell you what your risk profile it is. You have to think about your income. You have to think about your age. So what's your time horizon, your time to retirement? You have to think about what your own personal feeling towards risk is, how much money you have, all these things. And it's a personal question only for you, but you have to understand that. And the number 8, the last one, is that you have to think long-term, all right? Venture capitalists think long-term. Now think about this. A venture capitalist, they've been presented with, this invest in this new blockchain company. And this new blockchain company is going to change the way that computing is done and the way video processing is done. And they're gonna take Amazon's model and shave 80% off of it. And the market's huge and everything's big, but that market hasn't been created yet. It's not there. So it's gonna take me a long time. Now, a venture capitalist would have to put money in because they're taking like ownership, and they put money in and that money is not readily available. If that company doesn't succeed and doesn't ever go public, they'll never get their money out. And a lot of times that might take 5, 6, 7 years. As a matter of fact, most venture funds have about a 7-year time horizon. Now, a lot of times if we're gonna be investing into crypto assets, blockchain companies, decentralized companies, a lot of them are publicly traded. So that's what I like to call venture capital economics, because we're diversifying and putting money like a venture capitalist. However, we have open market liquidity because we can actively sell whenever we want. So we're like at an advantage. But a venture capitalist has to think long-term. They're locked into that play for 7 years, right? So they're thinking long-term, but they're also watching the stages and the milestones, and that's what I talked about before, that they're putting money in stages. So they're actively watching and participating with that company, staying in tune with that company, and investing along the way. And the number one rule to thinking long-term is being patient, right? They're not investing for next week or next month or next year, 7 years, and that's what it takes for companies that are coming out with brand new solutions that have never been to market before. That's what it's going to take for them to achieve this life-changing scale. And that's why venture capitalists make so much money. So even though the majority of their projects fail, maybe out of the 10 or 15, 5 of them fail, maybe 7 of them fail, maybe only 3 or 4 of them break even, the few that make it make huge returns, and they offset all the ones that barely broke even or took a loss because they were making such a big impact and they waited long enough for those companies to really be valuable. So that's it. 8 ways that a venture capitalist thinks, and that's why they're so successful. These are ways that you can apply right into your own life, all right? So when you're looking at any crypto assets, any blockchain companies, make sure to keep these 8 things in mind. Now, to make this easier, whenever you're doing your own research, DYOR, I have a free guide. It's a checklist, it's a PDF, you can download it and you can actually edit it, you could save it. So for every company that you evaluate, just use the guide and then save a copy of it. And then what you always want to do is you always want to remember that. You want to look back on that guide and think back, why did I buy this company? So if I bought this company today, I always have to keep in mind those original reasons. And so then if something changes with their vision, I can decide if I want to get out or not. So check the comments down below for the link. Download that PDF for the free guide, the DYOR, how to do your own research. Hopefully that's helpful for you. Leave a comment down below so I can engage in discussion and maybe you can win the $50. All right? That's it. Think like a venture capitalist and you're going to succeed. To your success. I'm out.